No, I can't hear you. Can you hear me? Okay, no, I can't hear you. I can't hear you. I don't know if Rainesh can hear you also.
No, 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 I can hear you also.
Okay, can you hear the teacher then, the professor? I I think there's something wrong with your mic. Maybe the mic setting or such, because I still can't hear you.
Can you hear me now?
Yes,
Yeah, you can hear me
Yes,
now, right? Yeah.
yes, now we
yes.
can hear you.
Okay, okay. Thank you. So let us now, should we start or wait for a minute? How many of you have joined? I think three of you. Should we wait for a minute or should we start? What do you suggest?
I don't know, maybe wait for a minute.
Okay, we'll just wait for a minute and then we'll start. In the meantime, let me share my screen. I think my screen is visible, right?
Yes, that's visible.
Yeah. So we are going to start with financial statement analysis, mainly the ratio analysis today. Uh, in the last session, I gave you some hint about how to go about doing financial statement analysis. By the way, did you get some time to go through the presentation that I had shared? Yes, or you could not find time or manage time? First of all, have you got the PPT, the presentation that I had shared? Yes or no? Did you get the PPT?
No, I don't see the PPT.
I shared it with
Oh no, wait.
Mir.
I think I'm looking. Did you share it? Hang on.
Can you see my screen? I think you should be able to see my screen. Yeah.
Yes, I can see
Mm.
the PowerPoint presentation.
What I was asking, the PPT, the presentation that I had shared last week, did you go through? Would you manage some time to go through? That is what I was asking.
Yes.
Have you got? Okay, okay.
Yes, I see. Yes, I see the one shared with Miriam, right?
Yeah, yeah. Mm.
Yeah, yeah. No, yes, we have that one.
Okay, let us start because you're already 5 minutes into the scheduled time. So 5 minutes first to the scheduled time. So let us start. So by now we have got some idea about what are financial statements and some basic understanding of how to go about analyzing financial statements. So we will do little deep dive into financial statement analysis. This is one of the core areas of financial analytics. So financial statement analysis is one of the core areas of financial analytics, right? So basically, what is financial statement analysis, often abbreviated as FSA? It is nothing but a process of examining. It's a process of examining, interpreting, and evaluating what? A company's financial statements. Why do you do so? You do so to understand its financial performance and financial position. And if you understand its financial performance and its financial position, especially its historical performance and financial position, you can extrapolate that and kind of predict the future. That means you can also kind of make some judgment about the prospects of that particular company. So that is basically financial statement analysis. So it's a process of examining, interpreting, and evaluating a company's financial statements with an aim to understand its financial performance, position, and prospects. Okay. So there are broadly 4 types of tools or techniques that we use when we do financial statement analysis. These are horizontal analysis, then we have trend analysis, then we have vertical analysis, and we have ratio analysis. So I'll come back to these 3 later. First, we'll start with what is called ratio analysis. This is the most important thing, right? So we'll get back to these horizontal analysis, trend analysis, and vertical analysis, but we will straight away jump into ratio analysis. Okay. So let me just jump into ratio analysis. Now the question is, what is a ratio? What is a ratio? Can anyone tell what is a ratio? What is a ratio? Anyone? What is a ratio? So let me give you an example to make you understand the importance of ratios. Say, for example, I'm talking about 2 countries, country X and country Y. I'm saying country X spends, say, 2 billion on education, and company Y or country Y spends 4 billion in education. Which country is more, concerned, and which country is giving more importance to education from this number? Suppose this is USD in billion USD. Country X spends 2 billion USD on education, and country Y spends 4 billion USD on education. Which country is spending or giving more importance to education? What is your answer? Yes, what is your answer?
Typically, you would say the one with 4 billion, but it has to be in relation to how many students there are, maybe. That's something we have to look at also.
Yeah. So basically, if I simply compare the absolute numbers, that may not make sense.
No.
Right? Because if I add one more data point, suppose GDP of country X is, say, 20 billion USD, and for Y it is 400 billion. So if I take spending on education as a percentage of GDP. So here that percentage comes to what? 2 by 20 into 100. That is how much? 10%. But here it comes to 4 by 400 into 100. That is only 1%. Are you getting my point? So comparing absolute numbers may not make any sense. But when we express a number in terms of another number, that is nothing but a ratio, then comparison becomes meaningful. Is that point clear? Yes or no? Is this point clear to everyone?
Yes.
Yeah. So this is why we use ratios. And what is a ratio? Ratio is basically a number expressed in terms of another number, right? So in finance, when we talk about ratios, basically we can think of 4 broad categories of ratios. One is called the profitability ratios. Second is called liquidity ratios. Third one is called solvency ratios. And fourth one is called capital market strength related ratios, or sometimes also known as valuation ratios. Okay. So let us look at each of these, categories one by one. First, we'll start with profitability. That means profitability ratios, the ratios that help us assess or evaluate the profitability position of a business. Okay. So profitability basically means the ability to generate profit, right? What all ratios we use to figure that out, how profitable a business or a company is? So there are many ratios that we compute, but mainly I will focus on these 4 ratios. First one is the profit margin, then asset turnover, return on asset, and return on equity. And in between, we'll also talk about some other ratios which are parts of these ratios, right? So let us first start with profit margin. Okay, it is one of the profitability ratios. So what is a profit margin? Profit margin is defined like this. Profit margin is equal to profit profit by sales into 100. Here sales is nothing but revenue from operations. Same thing, right? So if I say a company has a profit of say 21,514 and its revenue from operations or sale is 1,56,978, take any currency, suppose dollar, right? Then applying this formula, I can easily find out what is the profit margin. So profit margin is 13.71%. If I ask you to interpret this number, 13.71%, how do you go about interpreting it? Anyone would like to try? What does this number indicate? 13.71%. How do you interpret this? Yeah, please try.
That's that's a percentage of profit you made extra on the sales.
So
how to put it in another way.
Okay, you are very close. So basically you can interpret this number in this way. It basically means for every $100 of revenue, for every $100 of revenue from operations or from sales, you have generated approximately $13.71 of profit. Can I say like that? Yes or no?
Yes.
Correct. Now you tell me, if this ratio is high, is it good or bad? If your profit margin is high, if your profit margin, let us call PM as profit margin, if it is high, is it good or bad? Profit margin is high, good or bad?
It's good.
It's good because you want to make more profit.
Yeah.
So if you express in profit, so this can also be said that for every $1 of revenue, you are making a profit of approximately 13.71 cents, right? So ideally, you would like to make, maximize the profit per unit of dollar in your revenue, right? Yes or no? So the higher this profit margin, better it is. Now, why is it called a margin? Why is it called a margin? Can anyone tell why is it called a margin? Because it acts as a cushion. Say, for example, a company has a profit margin of 10%. It has a profit margin of 10%. Now, suppose the sale of that particular company falls by 20%, right? Sales go down by 20%. So that company will get into a loss, right? But another company which has got a profit margin of say 40%, for that company also the sales drops by say 20%. This company will still be making profit. So what does this mean? It means higher the profit margin, better is or higher is your margin of safety or cushion against the loss that might occur because of drop in your sales or increase in your cost. Is this point clear? Everyone understood? Because higher the margin, better is the margin of safety, better is the cushion against loss that might happen due to drop in your sales or increase in your cost. Is this concept clear?
Yes.
The concept of margin. Yeah. So obviously we would like higher profit margin. And in this case, if I compare the numbers, because as I said, ratios are basically computed for comparison purpose, right? And the comparison can be of two types. One is called intra-firm or the other one is called inter-firm. Intra-firm comparison and inter-firm comparison. What is the difference between intra-firm and inter-firm? Intra-firm means within the same company, same firm over several years. Inter-firm means you are comparing say X with Y, right? Company X with company Y, that is inter-firm comparison. But suppose you are comparing the profit margin of this year against the profit margin of last year, then that comparison is called what? Which one? Intra. So intra means within. Intra means within, and inter means between. Just remember this, then it will be easy for you to understand. So in this case, can anyone tell me, when I'm comparing profit margin of 2016 with that of 2015, is it a intra-firm comparison or inter-firm comparison? What is your answer?
Intra.
Intra, because I'm talking about the same company, but I'm comparing 2016 performance against 2015. Okay, that's the point. So profit margin, you understood. Higher the profit margin, better it is. Sometimes this ratio is also known as return on sales, because return on sales, ROS means what? return by sales. Return is nothing but profit. Profit by sales, same thing, right? So you got it. Next is asset turnover. What is asset turnover? Always remember, whenever we use the term turnover, basically turnover means sales. So asset turnover means, last session we discussed asset turnover. ATO, short ATO for asset turnover. What is the formula for asset turnover? Anyone remembers? Last session we discussed. What is ATO? ATO stands for asset turnover. What is the formula? Asset turnover, what is the formula? Turnover means sales. Sales divided by asset. Isn't it? Last class we discussed this. Sales divided by asset. Now, what does this ratio indicate? Can anyone tell? What does this ratio indicate? This ratio basically indicates efficiency in asset utilization. If this ratio is high, it basically means what? Suppose, let me assume that this ratio is equal to 2. What does this mean? If this ratio is equal to 2, it basically means for every dollar of asset, or for every dollar invested in asset, you have generated a revenue of $2. Yes or no? Can I say that? If ATO is 2, it basically means what? For 2 can also be written as 2 by 1. For every dollar invested in asset, you have generated $2 of revenue from sales, right? So now you tell me, if this ratio is high, is it a good thing or bad thing for a company?
A good thing.
Good thing. That means, please understand, you have invested in asset not for exhibition purpose, right? You have invested in asset for generating revenue. So if this ratio is high, means what? You are generating higher amount of revenue per dollar of investment in asset, right? So naturally, it is a good thing, right? So higher the asset turnover, better is the asset utilization, right? So in this case, you can see what has happened. Has the asset turnover gone up or gone down? If you compare this 2016 and 2015 numbers, it has gone up or gone down. What's your answer?
Down.
It has gone down. It has gone down slightly. It has gone down because in 2015 it was 0.8078, and in 2016 it is 0.7845. Now, if I ask you to interpret this 0.7845, how do you interpret this? It means what? Can anyone try? Please try.
Means the revenue from sales is lower than the assets invested.
Yeah, very good.
In
Very
assets,
good.
yeah.
Yeah. So you can say for every dollar invested in asset, the company has generated
Yeah.
approximately 78 cents in revenue, right?
Yeah.
Can I say that?
Yeah.
Or you can say for every $100 invested in asset, the company has generated approximately how much? $78.45, right?
Yeah.
And since it is less than 1, your revenues from operation or sales is lower than the asset. Okay. So a company which is growing at a fast rate, right, and which is utilizing its asset base properly, will have a higher asset turnover. And ideally, we would like this asset turnover ATO to be as high as possible, because it's a measure of efficiency in asset utilization. Is that point clear? Yes or no? Is this clear? Yeah?
Yes.
Yes. So let us proceed. Next is return on asset. This is very simple. ROA, return on asset. ROA means in numerator you have return. Return is nothing but profit. And in denominator you have asset. Multiplied by 100, that will give you the answer in percentage. Otherwise, it will be in decimal. Okay. Now you tell me, in this case, for 2016, return on asset is 10.75%. How do you interpret this 10.75%? Can anyone tell? Please try.
For
every dollar invested in the asset, you get 10% return or 10 cents
Yeah.
return.
10 cents, yeah.
10.75 cents in profit. Yeah, very good. Okay. So again, it's a no-brainer. Do you want this ratio to be higher or to be lower?
Higher.
Obviously, you want more profit per dollar invested in asset, right? That is what profitability is all about, right? Higher the ratio, better is the profitability. But if you compare, if you do a intra-firm comparison, if you compare 2016 against 2015, what has happened? ROA has come down or has gone up? Tell. ROA has
Gone down.
gone down. Right? Once you identify that the ROA has gone down, as an analyst, the next question you should ask, why? Why has it gone down? To understand why has it gone down, you can decompose ROA into two components. How do I do so? If you recall, ROA is equal to profit by asset, right? Return by asset, because return on asset. Now, this can also be written like this. Profit by sales into sales by asset. Can I write like this? Because sales and sales will be cancelled out. I'm still left with profit by asset. Can I write like this? Yes or no? Yes or no?
Yes.
Yeah. And profit by sale is known as what? Profit margin, EM. And sales by asset is known as what? ATO. So can I say ROA depends on two ratios? One is profit margin, the other one is asset turnover. Can I say that? Yes or no? So I can say
Yes.
ROA is equal to profit margin into asset turnover. Can I say that? I just showed it mathematically. Yes or no?
Yes.
Yeah. Now you see, all the business, all the businesses, especially those who are running the business, they are, kind of using either of the two strategies that I'm going to talk about for increasing the ROA. Before I say, you yourself try and answer. How can you improve ROA? Answer is very simple, either by increasing profit margin or by increasing asset turnover or increasing both. Yes or no? Because ROA is a product of profit margin and asset turnover. So all the business houses, they are trying to increase their ROA. Some of them are using the strategy of increasing profit margin. Some of them are using the strategy of increasing asset turnover, and some are fortunate to be able to increase both profit margin and asset turnover. Suppose if I take the example of Mercedes cars or the Ferrari, BMW, high-end cars, these companies also want to increase their ROA. Can you tell me what strategy they are using? Are they using the strategy of higher profit margin to increase ROA, or are they using the strategy of higher asset turnover to increase their ROA? What is your answer? Tell. They are using high profit margin strategy, right? Because they sell less, but per car sold, they charge a very high profit margin. Yes or no? Is that point clear? Hello, did you get
Yeah.
my point, what I just said? Now take an example of a retail store, a supermarket. They also want to increase their ROA. Can you tell me what strategy they use to increase their ROA? Do they use high profit margin or do they use high asset turnover?
For retail, I think
High asset turnover, because they sell more,
Yeah.
but per unit they charge less.
Yeah.
But BMW or Mercedes high-end car manufacturers, they sell less, but per car they charge hectic price, right? So they are betting on increasing the ROA from increasing the profit margin. But a retailer wants to increase his or her ROA by increasing the asset turnover. So every business person, knowingly or unknowingly, uses one of these two strategies to increase ROA. But if you are fortunate and enjoy, suppose if you are enjoying monopoly situation, that means you are the only seller in the market and that product that you sell is of high demand in the market, then you can increase your ROE by increasing both profit margin and ATO. Since there is no competitor, you can charge any price, right? And since the demand is high, your asset turnover will be also very high. But that's a very, very rare situation unless you enjoy monopoly in the market.
I have a question.
Yeah, please ask.
So for anything with regards like a surface, to a surface, let's say for example a nail salon, you also have asset turnover there, but would the focus be more on profit margin?
I did not get what business you said.
A nail salon.
Salon.
Yeah, nail for nails. Women
Nails.
that do nails, right?
Okay. So now that depends on whether how do they, that is basically service industry, right?
Yes.
So no, how do they charge their service? Are they charging premium price? Or you have to see what type of customers they get. The customers that go there, are they very rich and ready to pay very high price for the service that they get? Then they are following high profit margin strategy. But suppose they are providing their services at a very reasonable rate and they are catering to many customers, then they are using high asset turnover strategy. Right?
Okay,
Understood?
so depending on how much people are willing to pay for the service,
Yeah.
you can then
So,
okay.
That means depending upon how they are pricing their service, are they charging premium for their service? If that is the case, and they are suppose catering to very few customers, but they are charging high premium for their service, then they are following high profit margin strategy. But suppose they are charging very reasonable rate, but they are catering to many customers, right? So this is also a part of the strategy that you decide. Right? Both the ways you can increase your ROA, right? Are you getting my point? Understood this point? Yes. Yeah, is this point clear to everyone? Hello.
Yes.
Yeah. So the example that you gave for salon and all, so generally I think they do not charge a very high, I think, profit margin. So most likely they are trying to cater to more customers, but it depends. If they are trying to cater to more customers, so they are betting on increasing ROA by increasing ATO. Okay.
Is it a fair assumption to, let's say, for example, we have a franchise, right?
Mhm.
And they want to scale the franchise.
Mhm.
Is it fair to say that they are also looking at asset turnover in that
Yeah,
case?
yeah, yes, absolutely. Because if you are planning to expand and capture more market, what do you do generally? You go for turnover, more turnover, right?
Yeah.
And you go for less price so that you can attract more customer and capture customers from your competitors, right? So in that case, they are betting on high asset turnover. So this is a fundamental understanding that every business person must have. So whether they know this relationship or not, willingly or unwillingly, they are actually using these concepts in their day-to-day business. Right. Simple example, suppose you go to a shop, you want to buy some stationery items. Suppose you want to buy some pens, right? So price is say $10 per pen. Just an example I'm giving, right? If you say, I want to buy 100 such pens, the seller would be ready to give you a price, say, for example, $9 per pen, right? So in this case, what the seller is thinking, I am compromising little bit on price per unit, but since I'm getting to sell more units, so I'm betting on now asset turnover, right? Yes or no? Are you getting my point? So this is something that they use day in day out, whether they know this concept or not, because that comes from common sense, right? So if you get to sell more, you will be ready to sell them at a lower per unit price, because the drop in your revenue that is happening because of lower per unit price will be more than compensated by the increased number of units that you are selling, right? So that's the basic trick that you need to understand. Is this concept clear? Because this is one of the fundamentals, fundamental concepts in ratio analysis, right? Is this clear? Understood, everyone? Okay. Now let us go back again to the fundamental question that I raised, that why the ROA has decreased. Now, can someone answer why the ROA has decreased? Why the ROA has decreased? So ROA depends on two things, profit margin and ATO. Now see what has happened to profit margin. Profit margin has gone down. Yes or no? Yes or no?
Yes.
Asset turnover also has gone down.
Yes.
And return on asset has also gone down. So the decrease in ROA is contributed by both decrease in profit margin and asset turnover. Yes or no? Can you see? So I get the same answer. ROA can be computed like profit by asset, or ROA can be computed by this relationship, profit margin into asset. So you can see, if you simply compute ROA in this way, you can see that ROA has gone down, but you won't be able to answer why ROA has gone down. But once you break ROA into these two components, then you can easily see that ROA has gone down because both profit margin and asset turnover have gone down. Is that clear? This is what is called analysis. This is what an analysis does, or this is what an analyst is supposed to do. you should not only tell what has happened, you should also try and figure out why it has happened. Is this point clear? Understood?
Yes.
Yes or no? Yeah. And this analysis was done for the first time by a company called DuPont. DuPont for the first time showed how ROA can be decomposed into two components, that is profit margin and asset turnover. And hence it is called DuPont analysis. So DuPont analysis in simple term means decomposing a ratio into other ratios. And once you decompose, you can figure out why a particular ratio has increased or decreased. Is this point clear? Understood? This is called analysis. Is this concept clear? DuPont analysis, how I can decompose a ratio into several other ratios to figure out why it has increased or decreased. Is this concept clear to everyone? Yes or no?
Yep.
Yes.
Understood.
Yeah, good. Very good. So let us proceed now. Now we will talk about another ratio that is called return on equity. Another ratio that is called return on equity. So you tell me, what should be the formula for return on equity? ROE. What should be the formula for return on equity? ROE. Anyone? The answer is given in the formula itself. Return on equity. So in numerator you should have return. Yes or no? So return means what? Profit. And in the denominator you should have equity. Yes or no? Do you agree with me? Because return on asset formula was what? Profit by asset. So return on
By
equity
asset,
should be
yes.
what? Profit by equity.
Yeah, agree.
So when we computed return on equity, we were looking at profit per dollar invested in asset. When I am looking at ROE, I am looking at profit per rupee invested in equity, right? So this is a measure. This profitability measure is of interest for what? Shareholders or the owners, correct? But ROA is a profitability measure which is actually from the viewpoint of the total overall business. It means how much investment has been made in the business, and from that investment how much profit that you are generating, that is captured by ROA. But if you are the owner, your investment is nothing but the equity. So from that investment, how much return or profit you are generating, that is getting captured by ROE. So in this case, if you compare, you see the ROE has gone down, right? ROE has gone down. So this also leads to us the question, why ROE has gone down, correct? We will find out answer to this question in the next session, why ROE has gone down. Okay. Before I close, if I ask you a quick question, for 2016, ROA is 18.39%. How do I interpret this? You should say exactly the way we interpreted ROA. Can you tell me, what does this 18.39% mean? It means, anyone? You should be able to answer this.
For every dollar invested in equity, you have a return of 18 cents.
Approximately, you have a profit or return of 18 cents, right? And do you want this ratio to be higher or lower as an investor?
Higher.
As higher, obviously, because you are the shareholder. You want higher amount of return per unit or per dollar invested in equity, right? So, but you know, those are very simple things. But more important thing is to figure out why ROE has gone down. So to answer that, we need to break ROE into several other components and see what has happened to each of those components, and then we can conclude why ROE has gone down. That part we'll cover in the next session, because we are almost done. In fact, we are 3-4 minutes past the scheduled time. So next class we will try and decompose ROE into other ratios and figure out why ROE has gone. So I hope at least you have got the basic idea of DuPont analysis. DuPont analysis is nothing but decomposing a ratio into several other components to find answer to the question why a particular ratio has gone up or gone down, right? And that is what is expected of analysts. They should be able to tell why something has happened. Because to figure out what has happened, you can easily see what has happened. You can see that it has gone down, but more important is why it has gone down. So DuPont analysis helps us answer those questions. Why? We will cover that in next session. So we'll stop here today. Any question anyone has? If not, we will close the session for the day. Okay? Yeah.
Okay.
Yes.
So thank you very much for attending. Hope you are getting the concepts that I'm trying to explain. Please honestly tell, is it understandable? Are you getting the concepts that I'm discussing? Yeah.
Yes.
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 Yeah.
Yes, it's understandable.
My humble request is, please go through the PPTs, because things are interconnected. If you skip things and leave everything for the exam, it will be difficult for you. I'll share this PPT also, whatever we have discussed today. So please go through, and before you come to the next class, at least have a look once. Okay. So thank you. We'll meet
Share
again in the
this
next.
PPT in the Zoom chat, or
I'll share the PPT in WhatsApp. I'll share. Okay. You can share with the group. Huh?
okay.
Okay. Thank you. We'll meet again next session.
Okay.
Yes. Okay. Bye.
Thank you.